This cargo ship is motionless because the map of global trade has been redrawn. With the Strait of Hormuz under a de facto blockade, the systems that supported easy globalism and soft landings have stalled. This dashboard shows the disruption's scale. The blockade trapped 20% of global liquid natural gas and 27% of maritime oil. While markets monitor oil past $120, the deeper issue is structural scarcity. This bottleneck imposes a permanent surcharge on European industry. Because sustained energy scarcity erodes the margins required for traditional growth, yield optimization strategies are failing to keep pace. Navigating this environment requires an immediate pivot from paper returns to physical and geographic asset security. To generate capital in 2026, investors must move away from speculation and towards essentialism. This involves realigning portfolios with the new physical realities of the global map. This map compares the blocked corridors in the Middle East with the Northern Sea route. This polar path has become the only viable release valve for maritime logistics. Wealth generation here involves Arctic arbitrage, specifically acquiring distressed logistics firms in Northern Europe that are currently pivoting their operations to these polar routes. In the Southern Hemisphere, Australia has activated a $1.2 billion critical mineral strategic reserve, effectively de-risking the nexus between mining and national defense. The opportunity in Australia lies in owning the specialized processing and supply chains that move rare earths from the outback to the global defense sector. When global bottlenecks remain closed, true alpha is generated by owning the critical infrastructure and processing chains that allow goods to bypass those blockades. In Europe, the pushback of EU AI Act deadlines to 2027 has created a specific delay dilemma for large-scale technology projects. High-margin consulting capital is currently being generated by building localized, sovereign AI infrastructure for corporations that need to function across different legal jurisdictions. By designing systems that remain compliant with both Western and local data standards, you provide a necessary bridge that global corporations will pay a premium to utilize. Managing wealth in this era is an exercise in anti-fragility. The priority has shifted from simple growth to ensuring that capital is both preserved and accessible in a crisis. This chart shows the defensive transition, moving 15 to 20% of liquid portfolios into real assets for inflation protection. That segment includes prestige properties in Middle Eastern desert bunkers combined with high-yield agricultural land in Western Australia. Utilizing Middle Eastern residency programs alongside these physical assets acts as a mobility hedge, protecting capital from potential emergency wealth taxes in Europe. Balancing these global assets with domestic retail in high-growth hubs like India creates a cash flow buffer that is entirely disconnected from Europe's energy-heavy industrial cycles. In the current macro environment, a wealth manager who ignores geographic realities presents a catastrophic risk to your portfolio. Securing wealth in 2026 requires realigning capital toward physical sovereignty, owning specialized supply chains, and establishing multi-jurisdictional optionality.